I am so delighted to see so many of you here at the Jockey Club Hall and for this afternoon's program. And it's been a while since we've had a lunch program like this, and I want to thank all of you for being here. And you know, those of you, I think I saw some of you last week at our Thanksgiving. We've been celebrating. What I love about Hong Kong is we don't just celebrate for one day. We celebrate, some of us were fortunate enough to celebrate for 4 days. So, and I'm really, really delighted that, I'm really thankful. I think those of you who read my weekly message, I really do have a lot to be thankful for, and Asia Society does too, in that, remember a year ago, you know, those of us who remember a year ago, it was still in the midst of COVID here. And in fact, it was pretty awful a year ago, as I recall. And now we have come out of it, and we've been getting great visitors, and we've been, our programs are just really going from strength to strength, especially Vernon. I want you to know our BP programs are one of the best ever. Vernon Moore is one of our trustees, longtime trustees, and we've been talking about how do we increase quality as well as quantity of our business and policy programs. And it's programs like today that I'm particularly proud and that we are able to bring back more and more. And in some, you know, today's speaker, no introduction is needed because he is one of us. He has been here in Hong Kong for over 30 years, I think. And same thing with our moderator, Tao Wang, also is based here. So for us to put together a program like this is, when they're not traveling, it's actually quite easy. But now, post-COVID, everyone is traveling again. And so I'm really delighted that we can get both of them today. Shan Weijian Shan, who really needs no introduction. Shan, those of you who have not met him, is, again, he's been one of our longest member at Asia Society. Our history is 30-some years, and Shan has been a member for about 30 years, and was a good friend of my predecessor, the founding ED, Executive Director, Ambassador for 11. So we're really glad that, you know, 30 plus years later, and 3 books later, this is the 3rd book, and each one of them, if you do not have a copy of it, I know some of you already got him to sign, The Money Machine, Trailblazing American Venture in China. So I think it's probably one of the definitive book on some of the VC or his exciting career lessons he's sharing with us. So grab a copy. We have plenty in the back. Members have a discount. And those of you who want to grab as Christmas gifts, you know, Christmas is coming, you know, in a few weeks. So these are wonderful books to give. And I also want to mention another book by our moderator, Tao Wang, Making Sense of China's Economy. She just informed me, and I want to congratulate her. Martin Wolf, Financial Times, just named it one of the best economic books of 2023. So Tao talked about this program. In fact, she did a book program for us September of this year. And we're really delighted that, you know, we have talents, we have people like this here in Hong Kong that can share their expertise and their wisdom with all of us in doing this really interesting, difficult time. I think it doesn't look, you know, 2023, we're almost over. It's been on and off, been a very choppy year, some good and some bad. But overall, I'm thankful that Asia Society Hong Kong, we have done a, you know, tremendous job. And I want to thank my team, very lean team. I'm sure all of you are going through what we're going through, short of staff. At the height, we had about 50 people in Asia Society Hong Kong about 6 or 7 years ago. And now we have a staff of about almost half that. And we'll still be able to deliver quality programs. And in fact, one of the things we wanted to do with all the dooms and gloom about Hong Kong, I was just in New York a week ago for Asia Society Global Trustee meeting. And everybody thinks we're, you know, a couple of months ago, they think we're dead, right? And so we want to convince them that Hong Kong is alive and well. So it's wonderful to see this last 6 months, we've been having wonderful visitors coming, whether for conferences, on their way to China, on their way to Asia. In fact, yesterday, we were very happy. There was a private event, HKMA, all these central bankers who were here for the conference, they had a private dinner down at the landscape, at the Lippo Amphitheater. So Asia Society Hong Kong can share this venue with visitors as well as yourselves. And we want to continue that open arm and really let people know that Hong Kong is alive and well. Yes, like anywhere in the world, we're having, there are ups and downs in whether it's geopolitical and economics. But I'm thankful that we have a wonderful team, and I'm thankful that visitors are coming, and I'm thankful for all of you. And also, I'm thankful for the community. We've gone through a lot with the community this last 3 years with the Hong Kong community. We all know what happened in 2019, the last 3 years of COVID. Last year, we kicked off a campaign called Making a Difference. And what we were able to do is bring the Hong Kong community, especially the underserved, to Asia Society to help us celebrate Christmas. And last year, we had a wonderful celebration with the Christmas market. And this year, thanks to the French community, we're going to have the Christmas market again. It'll be February 8th, 9th, and 10th. And we want the community to come in. We will have celebrations, singing. We need Christmas more than ever. And so Making a Difference campaign is something that we are paying forward to the community. So I want to, it's on your chair. Take a look. And if you're interested in supporting, please let us know. Also, membership. You can buy books at our bookstore, member price for Christmas, but also membership. Feel free to gift a membership to your friends and family, because we need help. And I'm telling you this because after this program, I will have my annual, we do finance committee meeting twice a year, and Vernon is on the committee. So it'll be a very interesting finance committee meeting when I can update our finance committee on the state of affairs. We are still not out of the woods because of COVID, because we couldn't rent our facility out for 3 years. So we are still in the red, but the signs looks good. So I'm very optimistic that we're going to end this year with a bang. Those of you who have not been bombarded by our chairman, December 7th, our annual gala, we will be doing it. VIP reception will be here, and the gala itself will be at the Marriott, when we will have the Minister of Investment from Saudi Arabia speaking for us. And that promised to be a really fantastic gala to hear from a leader, a business leader, as well as a political leader from Middle East, from that part of the world, telling us his plans for the country and the region. So I invite you. There are still seats available for our annual gala on December 7th. And I know I'm telling you a lot of stuff, but I'm just excited to share all the stuff that we are able to do. And if you're interested in the arts, some of you, in fact, already came up to me. We have a wonderful artist, Master Pang Jun, in the Chantal Mella Gallery. And at the age of 87, he is still painting, and starting Monday, he agreed to do a live camp. He's doing live painting as we speak. He started on Monday, and it'll conclude on December 22nd, and he's painting a huge canvas, 70-plus meter canvas. And he is, the spirit of Master Pan inspires me. At 80-some years old, he is still painting, and the paintings are magnificent. So check out the exhibition, bring your family. The exhibition is free. Admission is free to the Chantal Mella Gallery. It's free here, and whenever you want to bring friends and family to come and check out I think we're really proud of our architecture. Last night, we wowed some of those central bankers from other parts of the world by showing this beautiful site in the evening. So I'm really delighted that all of you are here. And again, I want to thank Shan again for your wonderful support over the years, and congratulations on another successful book. And again, Miss Tao Wang, for her support. And so after you have your lunch, they will come up and get the formal program started. So again, thank you very much, and enjoy the lunch.
Hello, good afternoon. Okay. I know Shan doesn't need introduction. You are all fans of him. But I will say a few words anyway. First of all, thanks, Alice, for inviting me. I'm honored to be here moderating this session. But Shan also doesn't really need moderation, someone to moderate. So just very briefly, Dr. Shan Weijian is the executive chairman and co-founder of PAG, Asia-based and Asia-focused and Asia-based private equity firm with more than $50 billion in capital under management. Shan is also a trustee of the British Museum, as Alice said, also involved in Asia Society for multiple decades. She's also a member of the International Advisory Council of Hong Kong Exchange and independent director of Alibaba Group. Shan, you may have read his first book, Out of Gobi, so you know a bit about his history, and then he got his graduate degrees in the US and taught in Wharton before he worked in the financial sector or in business. So it's a great honor to be having this conversation with Shan about the third book, Money Machine. So just very briefly, it's about American private equity firm buys a state-owned Chinese bank, hires a foreign general manager, turns the bank around, and so on. It seems like really a fairy tale in today's era when everybody's worried about China, when the atmosphere between US and China is so tense. So without further ado, I would like to ask Shan to give us a bit of introduction about this book, what's behind it, what's the main story, and then I have lots of questions to ask. I'm sure you have questions too.
Thank you. Thank you so very much, Tao.
We're going to move the chair a bit.
Yes. Thank you. It's a great pleasure to be here. It's an honor to be here. Thank you very much for joining this event. Money Machine is my third book. It's a story about an American firm, Newbridge Capital, of which I was a co-managing partner. Newbridge Capital was affiliated with San Francisco-based TPG. And it was about Newbridge Capital buying control of a national bank in China called Shenzhen Development Bank. And foreigners buying control of Chinese bank had never happened before when we did it, and has never happened afterwards. So it was a very unique event. But the reason I wrote the book is not just to tell a story. There are many interesting stories to tell, especially in private equity, but to fill what I consider to be a void in the literature about private equity. Private equity investments have become a very big industry. It really started in late 1980s in the United States. If you remember, or you may not remember, the acquisition by KKR of RJR Nabisco, which was a $25 billion transaction. And that I consider to be the start of modern private equity industry. Today, there are twice as many firms controlled by private equity in the United States as publicly listed companies over there. So that's how big the industry has become. And yet, there's no single book before I published my second book, Money Games, that describes the entire process of how private equity actually makes money, especially the buyout type of private equity firms. That is, when you buy a company, how do you make money? Henry Kravis of KKR, which acquired RJR Nabisco, is very fond of saying, any idiot can buy a business. You just have to pay the highest price. It's what happens afterwards that really matters. For example, for KKR's acquisition of RJR Nabisco, $25 billion transaction, largest ever by that time in 1988, there is a book called Barbarians at the Gate, talking about the deal-making part of that transaction. The book was written 1 year after the deal was put together by two Wall Street Journal reporters. And of course, the book doesn't get into what happened afterwards. In the event, KKR held that investment for about 15 years and eventually lost money from that transaction. So the story about deal making was a good one. It was made into HBO TV series, and the book became a bestseller, and yet the deal was not so successful. So what really matters is what happens after you acquire a major business. And I thought there was no such a book, even though private equity buyout has become such a big industry. You know, every day you read in Financial Times, Wall Street Journal, even New York Times, you would find news about this private equity firm acquiring this iconic company, or that private equity firm buying another iconic company. So I thought that I would fill the vacuum by writing a book about the whole process of how private equity really works. And that was my motivation to write my second book, Money Games, which is a story about us, Newbridge Capital, buying control of a failed and nationalized bank in Korea, which used to be the largest commercial bank in Korea, called Korea First Bank. The Money Machine is sort of an extension from that, because after a successful turnaround and exit from Korea First Bank, we acquired control of Shenzhen Development Bank in China, which was even more unusual. It was unusual to buy control of a bank anywhere in the world, but especially in Asia. But to buy control of a national bank in China was very unusual, especially in view of the banking regulations restricting foreign ownership in Chinese national banks, or any bank, commercial banks, but especially for a bank with a nationwide footprint. So what happened was, around 2002, we started to look at Shenzhen Development Bank, or SDB in short. And the reason that we were allowed to look at buying control of national bank in China at all was because the regulators knew that we acquired control of Korea First Bank and successfully turned it around. And they thought that our experiences could be useful for China. And 2002 was really the start of China's banking reforms. See, going back to Korea, when we bought Korea First Bank, the circumstances were in the middle of Asian financial crisis of 1997. It was a very severe financial crisis which swept across Asia. It was like, people call it a financial tsunami at that time, came to Hong Kong as well. It started on July the 2nd, 1997, with a massive devaluation of Thai baht, the Thai currency. And then after that, there was massive capital flights from all Asian countries. And it came to Hong Kong around October of that year, 1997. On October 23rd, 1997, on one day, Hang Seng Index here in Hong Kong dropped 16%. Think about it. You know, the stock market dropping 16% on one day. That was how severe the financial crisis was. But Hong Kong actually weathered that storm pretty well. No bank failed. Whereas in South Korea, 150 banks failed, including its largest, including Korea First Bank. In 1997, the stock market in South Korea dropped 49% within that year. But that's not the worst. The currency, Korean won, lost 65.9% of its value in 1 year. So in US dollar terms, the Korean stock market dropped 82% in 1 year. Think about it. Korea built itself into the 10th largest economy by 1997. As you know, after the Korean War of 1953, Korea was in ruins. It was a poor country to start out with, but then it was ravaged by the war. So it took decades for Korea to build up its economy. And by 1997, it became a member of OECD, one of the developed countries in the world. And that is 10th largest in the world. And yet overnight, 82% of the stock market value was wiped out. So all the wealth built over decades was wiped out. That was how so severe the economic and financial crisis was at that time. And the situation became so dire that the Korean government had only $20 billion in its foreign exchange reserves to pay its foreign obligations. Just to put that into perspective, we, PAG, a private equity firm, manage $55 billion US. Korea, South Korea, as the 10th largest economy in the world, had only $20 billion left in its coffers. Right? Korea was going into bankruptcy. At the rate of capital flight, it had enough capital to last probably less than 3 days. That was how dire the situation was. The Korean government called upon the citizens to help and appealed to the citizens to sell their jewelry, gold, silver, and jewelry to help replenish the coffers of the state. But obviously that was not enough. It was at that point, International Monetary Fund, IMF, and the World Bank came to the rescue of Korea with a package of $58 billion. But with the condition that Korea had to sell one of its failed nationalized banks to foreign investors. Why was that condition? The idea was Korean banking system failed because there was a lack of credit culture. What does it mean? When banks make loans, they have to assess the ability of the borrower to pay back the loan. Simple as that. That's the credit culture. You have to look at the credit of the borrowers. But the Korean banking system prior to 1997 was not conducting banking based on the credit worthiness of its borrowers, but based on government's policy and relationships. And that was the undoing of the Korean banking system, Korea's banking system. So IMF thought, since there was a lack of credit culture, which was the fundamental reason why the banking system failed, inside Korea, you need to bring it into Korea from outside. And that's why they imposed this condition that they will have to sell one of the major banks to foreign investors, believing that the foreign investors would introduce credit culture into the system. And that's how we, Newbridge Capital, came into play in 1998. I went to Korea to negotiate with the government to buy Korea First Bank in competition against HSBC. Eventually, we got the deal. Now, what about China at the time? China was spared from 1997 Asian financial crisis because that crisis was triggered by massive capital flights. But for China, there was very little foreign capital to start out with. And there was no portfolio capital, meaning foreign capital in the stock market at that time. And the exchange rate was controlled. There was capital control in place. And therefore, there was no capital flight. So China was spared from Asian financial crisis, whereas countries like Korea, Japan, all the way to Indonesia were ravaged by the financial tsunami. But that didn't mean that the Chinese banking system was sound. So in 2002, when we started to look at the possibility of buying control of this Chinese bank, the Chinese banking system was exceedingly weak. The central bank, People's Bank of China, PBOC, made an announcement in that particular year in a rare moment of transparency. And it suggested that the non-performing loan ratio, and that is bad loan ratio, in the entire Chinese banking system was 30%. 30% was massive because for banks, the requirement by regulations around the world at that time was to have 8% capital ratio to protect the bank from different obligations and especially from bad loans. But when the bad loan ratio becomes 30%, you know that the entire banking system was insolvent. And in that particular year, again, 2002, S&P, Standard & Poor, the international rating agency, did a study of the Chinese banking system, also concluded that the bad loan ratio in the system was 30%. It further suggested that the total amount of bad loans in the system was $560 billion. Now, to put that into perspective, China's GDP in 2002 was only $1.1 trillion. So the bad loans in the banking system was more than 50% of China's GDP. Now today, China's GDP is $18 trillion. At that time, 22 years ago, or 21 years ago, or about 20 years ago, China's GDP was only $1.1 trillion. S&P suggested if China makes the effort to bring down the bad loan ratio, it would take China about 20 years to bring down the NPL, non-performing loan ratio, from 30% to a more manageable, in their words, 5%. So if their prediction, forecast, came true, then China would have a bad loan ratio of 5% only last year, over this 20-year period. In the event that didn't happen, and China engaged in banking reforms at that time, cleaned up all the major banks, created asset management companies to house the bad loans, and those asset management companies were given charge to dispose of the bad loans, and then they recapitalized the entire banking system, the state-owned part of the Chinese banking system. Well, practically every bank was state-owned, but there were some smaller joint stock banks, whereas the biggest banks were 100% state-owned. So it is in the middle of the banking reform, we were given the opportunity to buy control of this bank, SDB. At the time, and I think it is also true today, foreign ownership in the Chinese domestic bank should not exceed 20% for a single investor and 25% for all foreign investors. So how do you buy control of a Chinese bank if the foreign ownership was restricted to less than 20%? As it happened, SDB was very special. It was the first company to be listed on Shenzhen Stock Exchange. So its ticker number today is still 000001, right? Although the name has changed from Shenzhen Development Bank to Ping An Bank, because eventually we sold the control of this bank to Ping An Insurance Group. But at the time when we eventually acquired this bank, the bank was totally broken. The bad loan ratio reported at the end of 2004 was 11.4%. Again, the capital ratio required was 8%. The bad loan ratio was 11.4%, but that was nominal, that was reported. By our due diligence, the actual bad loan ratio was twice as bad, something like more than 20%. And its capital ratio was 2.3% nominally. In effect, the capital ratio was negative by our estimate by about $1 billion. It reported a profit of $40 million when in fact it shouldn't have any profit because it has substantially under-reserved for the bad loans. So the company was largely insolvent. And you ask the question why a bank that was insolvent could still stay afloat and continued to operate. And the answer is China had a lot of liquidity. The bank can operate as long as there's funding from deposits. And China is the largest saving country in the world. It has the highest savings ratio as a percentage of GDP in the world, still about 45% of GDP today. So we had enough liquidity from depositors to continue to operate the bank. But at one time, as I described in the book, we almost lost the bank due to lack of liquidity as depositors pulled money out of this bank. And we bought control of this bank, first time in the history of the People's Republic for a foreign investor to buy control of a bank in China. And then we appointed members of the board to control the board. Then we put in place an American veteran banker as chairman and CEO of the bank. His name is Frank Newman. He's no stranger to the Asia Society and to Hong Kong because as long as we controlled that bank, he lived here in Hong Kong and commuted to Shenzhen to do his job. He was the former Deputy Treasury Secretary of the United States and former Chairman and CEO of Bankers Trust before he sold Bankers Trust to Deutsche Bank. He didn't speak any Chinese at all, but he knew banking. And we thought it was much more important at that time to know banking, and not only to know banking, but to know how to turn around a bad bank. And he had experience in turning around a broken bank. He worked at Bank of America when Bank of America went into trouble due to exposure to Latin American debt. And he worked at Bankers Trust and turned it around. And then he worked with us as a board member at Korea First Bank and had first-hand experience working with us, turning around that particular bank. So we thought his experiences were highly relevant to help this problem bank, Shenzhen Development Bank, even though he didn't speak any Chinese. And my partner, David Bonderman, said maybe not speaking Chinese was an advantage for him because nobody would ask him for favors. And in the event, he did a very good job. And in 5 years, we totally turned this bank around. So in 5 years, we more than quadrupled the assets of this bank. In fact, 4.4 times we grew the assets of this bank. We brought down the bad loan ratio from in fact, about 20-some% to 0.6% when we sold it in 2010 to Ping An Insurance Group. 0.6% is the cleanest bank that you can find anywhere in the world. Our capital ratio from actual negative to 10.2% in 2010, more than the regulatory required 8% ratio. Our profitability went up 26.5 times, not percent, times in this 5 years, from nominally $40 million to about more than $1 billion, about $1 billion by 2010. So we completely transformed this bank when we exited this institution. Altogether, we put in about $150 million to buy control of this bank, and eventually we sold our stake for about $2.4 billion, a 14-time return for our investment. Financial reward aside, this is really a good story of how private equity investors turn around a troubled institution and create value, not only for investors, but for all the stakeholders of this bank, of this institution. And that's why I thought the story is very interesting and very relevant for whoever interested in private equity or whoever interested in China, and especially how in the golden era of China's economic reforms that the door was opened to foreign investors and what impact foreign investors had on the Chinese economy at that time. I will stop here and then we'll have a conversation with Tao. Thank you.
Thank you very much. That's a fascinating story. I just find myself glued to the words you're saying. As a macroeconomist, I actually lived through some of that, what you said. I was actually at the China desk at the IMF when you were taking over this bank. I can say that IMF have the access to non-official, non-published data at that time. So we wrote to then governor and the state council that the actual NPL ratio is close to 50% of the loan book, because the
50%.
Because the 30% is the reported number, and that often did not include the rural co-ops and so on, which are much worse, and also did not include the bad assets already given to asset management companies in '99. So if you put all that together, indeed the Chinese banking sector was insolvent at that time. And we were wondering who was going to be interested in buying any of them. And we were looking at Citi and HSBC, as you were discussing. And in that process, Newbridge became the first one. That took a lot of courage and foresight to see from all that ruins, all that number, the opportunity that's going to come. And also, I think you mentioned this is a great story, how private equity can turn things around. From a macro point of view, this also is a really impediment of how China was able to get out of the situation where everybody at that time predicted is going to fail or take a long time. And that took opening and reform. And when we talk about opening and reform, it seemed very abstract, but in your case, it's really on the ground, real work, and a lot of hard work and a lot of reform. So it's a great story, I think, especially at this time, to remember that China's growth is not all about export or about state control. Is actually about major transformations that on the ground work that entrepreneurs were doing. So to follow up on your setting the stage for the story, what was the most difficult thing that you had to deal with in taking over the bank and turning it around? You mentioned that Korea didn't have a credit culture. What was the situation in China?
The big difference between China and Korea at the time was in 1997, 98, during the Asian financial crisis, Korea had to bring in foreign capital and foreign investors. It had no choice. It was running out of money. It literally did run out of money. So it had to bring in foreign capital. But Korea was very reluctant to bring in foreign capital and to sell control of what used to be the largest bank in Korea. So they regarded foreign capital as a necessary evil. There was no choice. In China, even though the banking system was very broken, and I should say 50% of the assets are bad or were bad at that time, the reason the Chinese citizens never worried about the safety of Chinese banks was because the full faith of the Chinese government, which was in very good financial position, was behind its banking system. So the Chinese bank would not let any of the banks fail. And that's why the Chinese banks were able to operate. And that's why Chinese citizens had the confidence to put their money into all the Chinese banks. But around 2002 and 2003, when Mr. Liu Mingkang was appointed as chairman of this newly formed China Banking Regulatory Commission, he made a rule, a very interesting rule, that all the banks had to bring in foreign capital, foreign investors. So if you look at it, Bank of China brought in UBS, brought in, I forgot, some other foreign investors.
Bank of America bought the CCBs.
CCBs, Bank of America, and ICBC, Goldman Sachs, and Temasek, and so forth. Every bank was required to bring in foreign investors. Why? Even though China's financial position was very strong, it was because Mr. Liu thought that China didn't have the best practices in banking, and therefore it could only be brought in from abroad. And that was why we had the opportunity to buy control of this Chinese bank. So China didn't consider foreign investment in the banking system as a necessary evil. It actually welcomed foreign investment. I think they considered foreign investors as welcome angels. And that's what happened at that time. Every bank brought in foreign investors. And that was the big difference between Korea and China. And that's how the Chinese system was eventually turned around and introduced the best practices from abroad.
This, your answer backs the follow-up question, which is, as you mentioned, at that time, China was open and welcomed foreign capital. Can you imagine at this moment that are we, in a changed era? Can we still imagine, China welcoming foreign investors to take control over some large companies and turn it around?
Take control of large companies and turn it around, no question about it. You can still do it in China. And we have done it in the past few years. But to buy control of a Chinese bank will be exceedingly difficult. But honestly, there are no banks to buy in China because they're all in very good shape. And to operate the bank has become very expensive after 2008, the so-called global financial crisis. When I say so-called, because that crisis really affected North Atlantic countries, not so much here in Asia. It didn't really affect China or Hong Kong. And after that, the banking regulation was so much tightened that it has become too expensive to operate the bank. Reserve ratios have increased, capital ratio is increased, and the opportunities are not there. So at this moment, if you present a bank to me, I wouldn't buy it because there's no good deal to buy anywhere in the world anymore. But we are in the process of setting a company by name of Air Power, which is the largest producer of air products in China. Air products meaning oxygen, nitrogen, hydrogen, specialty gases for semiconductors. And this company's profit is more than $1 billion a year. So it's a very large company, and we have 40% market share. We bought this company initially by privatizing a company listed on Hong Kong Stock Exchange called Yingde Industrial Gases. And then we bought control of another competitor called Baosteel Industrial Gases from Baosteel, which is, of course, essentially state-owned company. We initially bought 65%. Eventually, we acquired 100% of that company. We merged two companies together, and we increased the profitability or cash flow of that company, EBITDA, from $400 million in 2017 to more than $1 billion last year. So it is still possible to buy state-owned assets. And you would find, by and large, state-owned assets are managed in a very inefficient way. So there are a lot of low-hanging fruits that you can improve the efficiency and create value. But it's no longer the theme. It's very rare for you to be able to do so. In the early 2000s, that was the theme of economic reforms. That is privatization of state-owned companies. Now, from here and there, you may be able to do it, but in general, it's difficult to do it.
It's good to know that it's still possible for private equity firms and foreign-owned firms to buy state assets and transform it. But you say it's rare. It's rare is because the state of the economy has changed? It's much more private-driven, or is it the state is more reluctant to sell the assets to the private sector?
I think the reform agenda has changed. At that time, it was really the effort to privatize state-owned companies as much as possible, especially those companies in competitive industries, not in natural monopolies like oil and gas. But today, I think it's not a general theme anymore. And in fact, there is a tendency for SOEs, state-owned companies, to expand at the expense of privately owned companies.
That's right. I think you exited in the right time as well in 2009, 2010.
2010, yes, we did.
2010. Because I think one would argue, I saw your article recently, one would argue at the moment when they're looking at China's economy, the state has had a comeback, but also the banking system, once again, are having a lot of probably non-performing loans that are most likely not reported. So after the global financial crisis, the banks were told to lend, and they're probably in the process created more NPLs during this period of time. So in your view, as people getting very nervous about China's debt problem again, what would you say? Should we be concerned, or we shouldn't be concerned so much? And also in terms of the government's change of reform priorities, what holds ahead for China?
I think the banking system in China is in very good shape, despite of all the problems that we read in newspapers every day. The property sector has many problems. And of course, banks are exposed to the property sector. And the Chinese economy or economic growth has slowed considerably. This year, it will only be about 5% in the years we controlled Shenzhen Development Bank, the Chinese economy was growing at double digit. But the reason I say that the Chinese banking system is healthy, is sound, is because of all the reforms that took place more than 10 years ago. Just to put this into perspectives, today, people are worried about the woes in the property sector. But Chinese banking system, their exposure to the property sector is very limited. Altogether, loans to the property sector represents about 23% of the entire loan portfolio. But 80% of that 23% are mortgages to individuals. For mortgages, the bad loan ratio is 0.5%. It's very low. And then less than 6% of the loan book is exposed to developers. All those loans, to my knowledge, are secured, and therefore they're relatively safe. So if you look at the bad loan ratio in the entire banking system, you already said in 2002 it was about 50%. Today it's 1.6%. And you say whether or not that number is reliable. I think it's quite reliable. The reason for that is also thanks to Mr. Liu Mingkang, the first chairman of CBRC, China Banking Regulatory Commission. He somehow adopted the rule that the bad loan coverage ratio had to be 150%. If you think about it, if you have $1 bad loan, you have to set aside $1.50 against it, then there's no incentive for you to keep the bad loan. And you want to get rid of it as soon as possible so that you can free up $1.50. Today, the requirement is no longer 150%, it's 100%. But on average, the bad loan coverage ratio in China is still 150%. So there's no incentive for banks to keep bad loans in their system as they did back 20 years ago. So they would sell off the bad loans as quickly as they become bad loans. But the reason I'm not worried about the Chinese property problem affecting the banking system is the Chinese system, as Hong Kong system, is very different from North American system, especially the system in the United States, where if there's negative equity, that is, if the housing price is lower than the mortgage value, then people can simply walk away from their homes, leaving the bags to the banks. And that's what led to the 2008 financial crisis. The housing crisis in the United States in 2008, when housing prices dropped by more than 30%, eventually led to the banking crisis. But in China, that would not happen. Why that is the case? First, the loan-to-value ratio, that is, the loan value to the value of the home, that ratio on average in the first-tier cities in China is only about 44%. In America in 2008, for some banks, that ratio went up more than 100%. So if the housing prices dropped in America by 10%, banks were in trouble. Right? That is actually happening to commercial loan market in the United States as the commercial properties lose their value. But at 44%, even if housing prices drop by 50%, it wouldn't affect the banking system that much. That's number one. But that's not the major issue. The major reason why a housing crisis will not lead to a banking crisis in China, which is the same story here in Hong Kong, is in America, homes are limited liabilities. As I said, if your home is worth less than your loan, you walk away from it. In Hong Kong, as the rest of China, mortgages are unlimited personal liabilities. You can't just walk away from your home and then say, I'm not responsible for the loan anymore. You still have to pay your loan back. And that's why in 1997, there was widespread negative equity here in Hong Kong, but no bank failed because very few people defaulted on their loans. And China has that system. So if you combine all these elements together, a housing crisis, even if it got into a crisis, will not lead to a banking crisis in China.
Great point.
Very different from some of the Western systems.
Great point. I would add to what you have mentioned before as well, which is liquidity. Banking crisis typically is a liquidity crisis in
Yes.
China because of that saving and capital controls, which keeps the saving in China, is really providing a big buffer for
In fact,
preventing.
the Chinese banks has had the opposite problem, too much liquidity. So last year, Chinese households increased their deposits in banks by 18 trillion RMB, which is about 2.6 or 2.7 trillion US dollars. That's an influx of liquidity into the banking system. This year, in the first half, by the end of June, the amount of increase in household savings was 12 trillion, or 1.7 trillion US dollars, 12 trillion RMB, 1.7 trillion US dollars. So there's just too much liquidity. And more than that, since 2022, Chinese households have prepaid their mortgages, representing about 12% of all the mortgages in the banking system. So banks now have to convince or persuade mortgage holders, homeowners, to keep their mortgages by cutting interest rates. So China has too much of a liquidity problem in the banking system at this moment.
Right. As you can see, as a macro person, I tend to divert the questions to macro, but I'm not going to hold on to microphone much longer. I know
By the
there's
way, all of what I have said just now about the Chinese banking system, the debt problem, and the property problem, you don't read in the mainstream press at all, and not even inside China, but certainly not outside of China, because people tend to not look at the entire picture, but at one aspect of either the property market or the banking system.
I think people tend to draw from their own experience in other countries and make an analogy and sometimes forget that China has some unique features, like
Yes.
the ones you mentioned.
For example, before you open the floor for questions, for example, people have focused on China's societal debt, government debt, especially local government debt. Every day you hear commentaries about China's debt problem. So China's central bank debt is 21% of GDP, among the lowest among major economies. And China's foreign debt is about $20 billion. Again, just 40% of the capital we manage, so it's negligible, for an $18 trillion economy. China's local government debt, there are many different numbers, ranging from 50% to 90%. If you take 90%, including all the hidden liabilities, the government platform debt, then the total government debt is about 110% GDP, compared with 140% for the federal government in the United States, 260% for the central government of Japan. So China's government debt altogether is not really high in comparison with other major economies, but that's only half of the story, because all these other major economies don't have much assets on the other side of the balance sheet. Think about the US government. What assets does it have? It has Amtrak, which loses money. It has post office, which loses money, right? It doesn't really have assets. Chinese government state-owned assets account for about 70% in terms of net asset value, 70% of GDP. So IMF estimated the Chinese government is in a positive net worth position. That is, assets minus liabilities is still positive, which is unique among major economies. And that's why I think in times like this, China should expand its fiscal policy because it has ample room to do so, more than any other major economy in the world. So commentators tend to look at one side of the balance sheet without looking at the other side of the balance sheet. But you think about it, you hear about SOEs all the time. And there are a lot of assets out there owned by the Chinese government.
Indeed, although I'm not as positive as you are on China's macro, but indeed I think it's important to know that China has assets. The state has assets. They just need to monetize it, and also they need to unclog this local government relations and so on. That's another story. I would be happy to open for Q&A. I know we're running short of time, so please.
Thank you. It's a fascinating discussion. So I'm Jean-Marie.
Thank you very much for coming.
I'm from Wells Fargo. I've been, I'm not revealing my age, but I've been a couple of years in working for a bank. I'd like to speak a bit about regulations and how it did impact your decisions. So sometimes, to be a bit more precise, sometimes we would regard regulations, particularly in China context, as really a kind of things that we don't know too much, especially as foreigners, and therefore introducing elements of uncertainties, which I would, and reading through your book, you are listing a number of times where it created headache in your discussions with multiple parties, from governments, and on the other hand, you're also picking up a couple of examples where, especially at the beginning of your investments, when SDB was still undercapitalized, regulations are tools that governments can use to give you flexibility to fix the bank for a longer period of time and tolerate that you could remain listed while you were still undercapitalized. So, through this example today, broader than SDB, what would be your takeaway? In what sense do countries that are more or less regulated, in what way does that influence your decisions when making an investment?
That's a very good question. I think it's very debatable for any country if there should be more regulation or less regulation. And sometimes you don't know what the optimal balance is. The problem is not whether, in my view, there are more regulation or less regulation, but whether or not there's regulatory stability. And that is, there are policies and regulations that you can predict and you can operate within. For example, if the regulation says you can't invest in banks, we will know that, and then we will not invest in banks. But if you have invested in the bank, then all of a sudden the regulation says, well, we double the capital ratio. Then, of course, that would impact your investment very severely because it makes the bank twice as expensive to operate. I think the problem with the Chinese economy in the past 2 to 3 years is that there was policy initiatives which were unpredictable. And they came as surprises and therefore shocked the market and spooked the investors. For example, China took out the after-school tutoring business overnight, right? And that really shocked the market and wiped out probably $1 trillion of market cap of all the Chinese stocks because the market didn't know what was coming next. In the United States, for a long time, for-profit university was a very attractive sector for private equity investors. And in fact, many people set up for-profit universities in the United States, subsidized by the federal government. Even Donald Trump set up a Trump University, which many people suggest it might have been a fraud. So eventually the federal government cracked down on subsidized for-profit universities. In about 5 years, that sector lost about 90% of its value. In China, in the education sector, it also lost 90% of its value, but not in 5 years, but in 5 hours. So that's the problem. You can have a new policy, but if you go through a process and over a period of time, a consultation process, then the impact on the market is much less than if you do it without warning to the market and without transparency. So I think that was what you talk about, that is unpredictability in the regulatory regime. And that's very damaging for the economy because the market is very fragile. It reaches equilibrium, it disturbs the equilibrium, then everything is out of whack. And that's very damaging to the economy. I have reason to expect that there will be more policy stability in the next few years based on the experiences of the last few years. But it will take a long time for me to get into why I have that confidence that more policy stability can be expected going forward.
Thank you. Next.
Hi, Weijian. I think you really like big picture, so I'm going to give you a big picture question. You mentioned about the PE industry started in 1980s. Let's say in 100 years, in 2080s, maybe I won't be here, maybe a lot of us won't be here, but for our future generation, do you think private equity will be here? And if it is still here, how it would look like?
If you're not here, I wonder what would happen to me. I was just telling Tao this morning that I never look at my schedule beyond today. I don't plan for the future. I look at my schedule that my secretary gave to me on day-by-day basis because I don't want to worry about the future. Now you want me to worry about 100 years from now. I would expect a private equity to stay and continue and maybe even expand in the next few decades. I don't see any reason for this industry to either shrink or disappear. The reason is that I have confidence in the market economy. If you look at how China has developed in the past 40-some years, many people suggest that there's some kind of a unique China model that was responsible for China's miraculous economic growth. I would say that the magic for Chinese growth lies in the market economy, because when I was working as a hard laborer in the Gobi Desert, all the economic activities were controlled by the state, by the government. And that system didn't produce prosperity. It produced only poverty. We couldn't even feed ourselves. So that's why I tell people, that's why I look so famished even today. Right? We were starving at the time. It was because Deng Xiaoping embraced a market economy, open door policy that really propelled China's economic development. So market economy is a solution to economic growth anywhere in the world. I'm quite convinced of it because we lived through the other system ourselves. Now, as long as there's a market economy, then you need a finance sector. And private equity just makes the market much more efficient. If a firm has failed, private equity will step in to acquire it, improve it, turn it around, and then restore the health. So it plays a very important function. One big difference in common perception and the reality for private equity is not a business of buying low and selling high. Anybody can do that. And market is efficient. It's very difficult to find opportunities that's below the fair market value, and then you can sell at more than fair market value. The way that private equity creates value is by improving its operations, just as I described in my 2 books, Money Games and Money Machine. And if you play that important function of improving efficiency in the system, how do you disappear? It's like sharks will not disappear. That's the wrong analogy. But I'm a diver, so when I dive among the sharks, sharks never bother a very lively person. Sharks typically would attack a sick fish or dying fish, right? They clean the ocean to make the ocean very healthy. But I realize I used the wrong analogy.
Maybe the right one.
But you need to improve the efficiency of the system, and private equity plays that role.
Thank you. I don't know how much time do we still have. 5 minutes. Okay, maybe. Quick question.
Hi, I have 2 questions for you. One is about the books. After reading The Money Games and The Money Machine, I found out you spend about 70 or 80% in Money Games to talk about the pre-closing deal, and then very little time to talk about how you exit. But in the other book, you spend 50% on how you close the deal and how you exit. Any reason why you did that? And the question for my second question is, I'm very happy to know that you're so optimistic about the banking system in China. But what if the Chinese government put in that whitelist 50 developers into the banking system? According to the news, it's non-secured. So would you be still optimistic about that?
When I was writing the 3rd book, I got more experienced writing than when I was writing the 2nd book. So I thought there should be a good balance between deal making and what happened afterwards. In the 1st book, it was very complicated transaction negotiating with the Korean government in combination with HSBC, and that's why I devoted so many pages to the negotiation process. It was, you would admit, quite dramatic process with all the ups and downs. But indeed, the true story in the 2nd book started with what Bonderman told me on December 23rd, 1999, when we were signing the final agreements for that bank. And he said, Shan, the hard part has just begun, and that is turning around that particular bank. Both are important. You need to put the deal together, and then you need to turn around the institution. And I'm glad that you noticed the difference. And I also got better when I was writing the 3rd book. Whitelist. What was the whitelist?
Maybe I can help answer the question. The whitelist is reported about 50 developers or so that the government has put together, basically asking banks to help them, to give them more credit. And so actually Shan already kind of answered that question, because he talked about the banking system's exposure to the property sector is about 23-24%. 80% is mortgage, 20% is to developers, right? So 20% times 24% is about a very small share,
yes.
Right? So so that 50 developers is within that small share. So even if you add them to it, it's not going to systematically affect the banking system. But the banking system's exposure to local governments are far larger. But as Shan mentioned, local governments do have asset. So I think the answer still stands. Yeah.
Local governments are very different. There are rich provinces and there are very poor provinces. The fact is that they cannot consolidate. They cannot offset each other. So provinces like Zhejiang and Jiangsu are very rich. They will give us interest-free loans to lure us to set up operations in their provinces, whereas places like Guizhou are much more cash-strapped.
Yeah, I know there are still a lot of questions. We are running out of time. Sorry about that, but you're encouraged to read the books. Very exciting to read. I read it in 2-3 hours. Shan indeed gets better with each of his book.
She's a speed reader. I can't even read in 2 to 3 hours.
Maybe because I know some of the background.
Yes.
Thank you so much for
Thank
coming.
you.
Thank you both. Thank you both. And I think Shan said the book also audio book coming out soon
Yes.
in the book. So I now
No,
read.
no, not coming out. It's out.
It's out.
Yeah,
Okay.
it's
So
in print,
those of
in
you,
electronic form,
those
in
of you
audio
who are
form.
audiobooks filed like myself, you can find them. But I want to thank both of you, and thank you all for being with us this afternoon for a really thoughtful program. And we will have both of them back anytime they want. And again, thank you all for being with us, and have a wonderful afternoon. Thank you.
Thank you. Thank you very much.
And buy the book. There are still books out there. Okay.